Hi everyone and welcome to Wall Street Multimedia's Market Watch. I'm Tiffany Liu with the latest market news. On Monday, Chinese stocks headed for their longest stretch of gains in 2 months as smaller companies extended a bull market rally. The Shanghai Composite advanced for the fourth day in a row, finishing above 4,000 for the first time since July 1st. The benchmark has rebounded 14% since July 8th, however, a fifth of the market remains frozen. Commodity prices fell close to their lowest in 13 years on Monday, weighing on U.S. markets. Some analysts are now saying falling commodities could affect the likelihood of a Fed rate hike this year as price pressures fade. On Tuesday, U.S. stocks declined, with the Dow tumbling 200 points midday as quarterly results from IBM and United Technologies disappointed investors. Now we'll be speaking with Peter Costa, who will give us his expert commentary on the U.S. and Chinese stock market. So Chinese stocks headed for their longest winning streak in 2 months on Monday as investor confidence picked up. Is this a sign that the Chinese meltdown is over, or will we see long-term effects going forward?
Well, I do think there's always, I think it's more of a short-term effect because investors have a very short memory. So you have investors that might have really taken a beating over the last, month and a half or whatever. And I think that once the markets get back to at least a point where people are seeing profits in their accounts, they completely forgot what happened. So, that's always been a thing, is that, investors should be more cautious about bubble type markets, but they never are, and the market could tank for a month and then rally back. People completely forget what just happened. So investors' memories are very, very short.
The Shanghai Composite has rebounded 14% since July 8th. But however, a fifth of the market still remains frozen. As a Western investor, how would you read this news, and would it affect your confidence for investing in Chinese stocks?
Well, my confidence in investing in Chinese stocks is very limited. I believe that there's still a lot of things that the Chinese economy and Chinese markets and Chinese corporations, I think that they need to be a little more aware of the fact that American investors don't trust them. They don't trust the numbers that we get out of them. There's very few companies in China are looked at with, there's a lot of positive and very, very good companies, but as far as the data that comes from China, it's always, we look at it differently. We have set accounting standards that every company must follow. Chinese standards are different, so it does take some time. I do think that American investors are very leery of the Chinese market. And it's a shame because there's a lot of capital in the U.S. that probably could be put to very good use in China as well. So, it's going to take time. It's going to take time to get U.S. investors' confidence.
Since the start of earnings season, U.S. investors have been turning more inwardly to domestic market news. Considering this, do you think the U.S. markets will shoulder any spillover effects from the Chinese stock market?
No, not really. I think that the biggest effect is, who does business with Chinese companies, and, are they going to be impacted? That's where you'd worry about your U.S. companies. The bigger issue is people investing in the U.S.-centric companies because there's very little dollar exposure. And I think that's a much bigger issue going forward for any investor, is how much exposure to the euro, and the U.S. dollar. What is it? If you have a big exposure, you're going to be affected by the strength of the dollar. So, you want to be careful about that. The Chinese, relationships, a little bit different. It's a direct investment, and I think that you're not going to see that much. That's not a focus of what people are looking at.
That's it for this episode. I'm Tiffany Liu, and thanks for watching Market Watch. I'll see you again next time.